The underlying is a fundamental concept in derivatives trading, as it allows investors to speculate and take positions to limit the downside risk of future movements. In addition, it represents the component of the agreement that provides value to the contract. Some examples of underlying are stock, index, commodity, etc. Deriving a common rule for future pricing is a challenge, as the underlying asset could be shares, bond, commodity, or index. Each has a different demand and supply pattern, and projecting a common pattern for them is not possible. All of the above financial instruments have different characteristics to fulfill different needs for different class of market participants, and will definitely have different cash flows. Cash and carry model is also known as non-arbitrage model. This model assumes that in an efficient market, arbitrage opportunities cannot exist. If an opportunity exists, arbitrageurs will start trading there and the opportunities will get eliminated. The cash and carry model says that futures price should depend upon two things: the current spot price and the cost of carrying or storing the underlying from now until the futures contract matures. Cost of carry of a financial asset from today to the future date would entail different costs like transaction costs, custodial charges, financing costs, etc. In commodities, it would also include costs like warehousing cost, insurance cost, etc. When we use a mathematical expression using the cash and carry model for commodities and non-commodity asset, we get this expression, where SO is the current spot price, FO, T is the current futures price for delivery of the product at time T. CO, T is the percentage cost required to store or carry the commodity from today until time T. The cost of carrying or storing includes storage costs, insurance costs, transportation costs, financing costs. Time, which is denoted by T, is expressed in terms of years. In this example, calculate the futures price of 10 gram gold for 3 months contract where the spot price is rupees 30,000 and the cost of financing including storage is 12% per annum. As you can see in these two steps, using the formula for 3 months at 12%, future price is rupees 30,888. Go through the working to understand the example. If the future price on the exchange is more or less than the calculated price, that is rupees 30,888, there is an arbitrage opportunity and market participants will take positions accordingly. There can be 3 scenarios. Scenario 1, when the future price on exchange is more than the calculated future price. Buy in cash market and sell in futures market. Cash and carry arbitrage takes place. When the futures price on exchange is equal to the calculated future price, then there is no opportunity for arbitrage. When the futures price on exchange is less than the calculated price, then sell in cash market and buy futures. Cash and carry reverse arbitrage takes place. In each scenario, there are 2 positions taking place. Either buy or sell in cash markets and buy or sell in futures market. This simultaneous buying and selling of the same underlying at same expiration date is called synthetic forward or futures.